Hey everyone, it's Matt Channel with a quick update discussing the news yesterday with the Fed dropping the rate. So how does that affect you? We'll kind of talk about that a little bit here. So yesterday, the Federal Reserve dropped its funds rate by 0.5%. It's actually the first cut that they've made in 4 years, bringing their target rate to between 4.75 and 5%. Now, even though that sounds like big news, the mortgage rates didn't really react much since the market had already factored in this rate cut that they were anticipating was going to happen. So, in fact, the U.S. 10-year Treasury, something that influences mortgage rates, actually went up just a bit to 3.71. So, why did the Fed cut rates? The labor market has been slowing down. We've seen stronger job reports earlier in the year, but it turns out those numbers were adjusted down later. And so the Fed is just trying to get ahead of any bigger economic slowdowns that they might see coming. And so what it sounds like is even after the election, November, December, when the Fed meets again, there's a good chance we're going to see another drop at the tail end of this year. So now, how does all of this affect you if you're looking to buy a home, right? While the rates didn't move much today, the trend is definitely of them going down, right? So if we back up about 2 months, rates were sitting around 7.25 if you were looking at a $250,000 loan, let's say, right? So today we're closer to 6%. So if you're buying, your monthly payment's down about $200 a month. And so that either allows you to move up a little bit in buying power, you can purchase a little bit more, or it just makes the home more affordable and your overall payments going to be less, right? So a lot of people ask me, reached out yesterday and said, hey, how is this all connected? What's going on? And so let's talk about how the Fed and the mortgage rates are actually connected. So when the Fed cuts the interest rates, it doesn't always mean that the mortgage rates are going to fall right away. So the Fed controls short-term rates like credit cards, home equity loans, but mortgage rates are actually more influenced by the long-term bond market, specifically the 10-year Treasury note. So while the Fed's moves can put pressure on mortgage rates, it's not always immediate. So the bond market actually plays a big role here. And so when investors think the economy is slowing down or that inflation will drop, bond yields and mortgage rates tend to start going down. So, but sometimes there is a lag and rates might even go up temporarily depending on how the market feels. I mean, sometimes we've seen the Fed drop and then mortgage rates actually go up a little bit. So to wrap things up, while the Fed's cut yesterday is pushing mortgage rates down, there are many other factors at play, okay? It's not a direct connection. So the good news is the rates are definitely trending lower. So if you're thinking about buying, now might be, definitely a good time. It's definitely better than the beginning of the year as the rates continue to drop. If you guys have any questions or want to chat about it, let me know. We'll see you guys next time.